Welcome to my channel. I'm Scott, and in this video we're going to dig into the balance sheet. The first thing we're going to do is define what is a balance sheet, the high level understanding. Then we'll go through a basic balance sheet, a more complex balance sheet. I'm going to show you where the numbers come from. We'll take a look at Microsoft's latest balance sheet. I'll show you a bunch of ratios that are tied to the balance sheet, and then a quick summary. A balance sheet shows a company's assets, liabilities, and equity. A balance sheet always shows a point in time. Think of a picture. When you take a picture, it's a point in time. An income statement is like a movie. It gives you a span of an amount of time. If you looked at a company's year-end income statement for 2021, it provides you the revenue for the entire year of 2021. But the balance sheet just shows the balance at the end of 2021. So the balance sheet is a snapshot of what the company owns and owes. The most common formula is assets equal liabilities plus equity. You can see assets right here on the scale. It has to equal owner's equity plus liabilities. If you do simple algebra, you can subtract equity from both sides, so you can use the formula assets minus equity equals liabilities. If you subtract liabilities from both sides, assets minus liabilities equals equity. I think the bottom one makes the most sense, because if I said my assets are $200,000, my house is worth $180,000, and my car is worth $20,000. And then I say my liabilities are $50,000. That's how much money I owe on my house. I don't have any other debt. You would say your assets are $200,000 minus liabilities are $50,000, so your equity or your net worth is $150,000. But if you look in any college textbook, they usually use assets equal liabilities plus equity. The three main financial statements are the balance sheet, income statement, and statement of cash flows. The balance sheet is always a snapshot. The income statement and statement of cash flows are over a period of time. It could be over a quarter or a year. And if you're new to investing, it can be confusing because sometimes you cannot find the balance sheet on the company's 10K. They may call it the statement of financial position, the statement of financial affairs, the net worth statement, or if it's a company that owns a lot of other companies, they may call it the consolidated balance sheet or consolidated statement of financial position. But if you look at a report that has assets, liabilities, and equity, it is the balance sheet, regardless of what the name is. Here's a really basic balance sheet. Here's a company, Flowers by Irene. It's a small flower shop that Irene owns. She has cash of $400. She has a bunch of flowers in inventory of $100. So her assets are $500. This is what she owns. That's on the left side of the balance sheet. The right side is what she owes. She owes $200 to her vendors. She bought some flowers on credit, so $200 of accounts payable. And she owes $300 to the owners of the company. She's the owner, so this is all hers. So the equity, the value of the company is $300. So you can see assets equal liabilities plus equity. If this said shareholders equity, that means it's a public company and the shareholders own the company. This entire PowerPoint presentation and all the graphs in Excel are on my Patreon channel. So if you're a member of my Patreon channel, you can access all the information in my videos. This balance sheet is a little more complex. Isaac's Retail Supplies. It's a manufacturing company that sells supplies to retail stores. And it still follows the same formula, assets equal liabilities plus equity. They have a lot more assets, so they break it down to current assets and non-current assets. Current assets are assets that can be sold or used within 12 months. What does that mean? It just means these assets will turn into cash within the next 12 months. And it's listed from most liquid to least liquid. Cash is the most liquid. That's a definition of liquid, cash. Liquidity is defined by how long it takes you to turn something into cash. Short-term investments are next liquid because you can easily turn them into cash if they're stock. As long as the stock market is open, you can just sell the stock and get the cash. Accounts receivables and other receivables are what people owe you. U.S. companies follow GAAP, and GAAP requires a company to list assets and liabilities from most liquid to least liquid. Not every country follows this method. Some countries list assets least liquid to most liquid. The current assets are used to fund the company's day-to-day business. So you want to make sure they have enough current assets on their balance sheet to cover their current liabilities. Because if they don't, then that means they may need to take on debt just to run their operations over the next 12 months. This company can cover their current liabilities. But if you want to do a little more detective work, you can look at the current liabilities. Let's take the most extreme example. If the only current asset the company had was cash of $128,000, then you can deduce the company's in fine shape. They have enough liquidity to get through the next 12 months. But what if all $128,000 was in inventory? Then you might be a little concerned because it's not that easy to convert inventory into cash, because you have to sell the inventory to your clients or use the inventory to make a product and then sell that product to your customers. If you're in a real bind, you might just have to sell your inventory for a discount in the secondary market. Now let's look at non-current assets. The balance sheet I created doesn't say non-current assets, so it could be confusing if you're a new investor. Where are the non-current assets? You could assume everything below current assets is non-current. I just broke it up so it's visually easy to see. Non-current assets are illiquid, and some non-current assets like goodwill you can't sell at all. I broke apart non-current assets into PP&E and intangibles because property, plant, and equipment gets depreciated. Land is an outlier. It does not get depreciated. It stays on your balance sheet at original value. The gross amount of our CapEx is $5,500 plus $6,500 plus $250,000 plus $125,000. That's a gross amount. We have to minus depreciation of $50,000. So the net amount is $337,000. That's the value of these assets according to our balance sheet. You can assume every single number is positive when you look on the balance sheet. But the only time this rule is broken is when we use a contra account. Accumulated depreciation is a contra account. A contra account reduces the value of a related account. The reason we use contra accounts is to preserve the historical value of the main account. It also helps us to keep our records clean. Let me give you an example. Let's just pretend there's no land improvements, and there's no equipment. There's just buildings of $250,000 and accumulated depreciation of $50,000. Those are the only two items on the PP&E section. By looking at the balance sheet, we know the original value of the buildings, the original amount we paid was $250,000. And as of the end of 2021, we depreciated $50,000 of that $250,000. So the value of our buildings, according to our balance sheet, is $200,000. It's the original value minus accumulated depreciation. Some companies just put $200,000 on their balance sheet. But if they do that, then you don't know how much they originally paid for the buildings. But now we do know the original price and the depreciation. Let's just say, for instance, the company sold the building for $500,000. Since the balance sheet says it's worth $200,000, that means we have to report a $300,000 gain on the income statement. $500,000 minus $200,000. If we sold the building for $150,000, we would have to report a loss of $50,000 on the income statement. We have goodwill of $105,000 and other intangibles of $200,000. Other intangibles might be copyrights or trademarks, or it could be something else. Goodwill is the premium you pay when you acquire another company. Let me give you an example. Let's pretend a bigger company acquired Isaacs, and they paid $374,000 for this company. But Isaacs is only worth $274,000. They paid $100,000 more than it's worth. So the company that acquired Isaacs gives the owners $374,000 in cash. The new company consolidates all of Isaac's financials onto theirs. They take all their assets and put it onto their balance sheet, and all their liabilities and put it onto their balance sheet. The equity from Isaacs goes away because the equity is what the owners own, and the new company paid off the owners, so there's no equity in Isaacs anymore. But something is off because the new company is receiving assets of $770,000 and liabilities of $496,000. Assets minus liabilities is $274,000. but they paid $374,000. So to make the balance sheet balance, they add $100,000 to goodwill. So if they had no goodwill on their balance sheet before they acquired Isaacs, they now have $105,000 plus the $100,000 from the acquisition. And now the new company's balance sheet balances. Because the new company's assets went up $870,000 and their liabilities went up $496,000 and their cash went down $374,000. So that's how everything balances. You may be wondering, where do the numbers come from that are put onto the balance sheet? They come from the company's trial balance. All companies create a trial balance to help them make sure their numbers tie. They have to make sure the debits equal the credits, because if they don't, then they can't create a balance sheet and income statement because those won't be correct. So throughout the year, they've been updating their ledger accounts. Every single transaction they input into their computer system. Every time they sold product from a customer and received payment, every time they paid employees, every time they bought supplies, the transaction goes into their general ledger. So the general ledger can be thousands of pages long because it's every single transaction for 2021. But only the balance of the general ledger accounts, the cash balance at the end of the year, the accounts receivables balance at the end of the year, goes into the trial balance. So the trial balance report may be only a few pages. So at the end of the year, this is how much cash we have. So this goes onto the balance sheet. Our balance sheet will have $35,600 of cash. This is a different company, Scott's Energy Company. The trial balance is not colorful like this. It's usually all white. I just made it colorful to show you how things are broken apart. The top is the assets, and it's based on liquidity, the most liquid to the least liquid. So this company has only 4 assets. So these 4 assets will go onto the balance sheet. They have 3 current assets and 1 non-current asset. And these 2 liabilities would go on their 2021 balance sheet. On their 2021 income statement, they have revenue of $50,000, expenses of $40,000. So their net income would be $10,000. And remember, that $10,000 goes into retained earnings. Here's Microsoft's first quarter balance sheet. They list assets up here. You have current assets, cash is on top. Then you have non-current assets, PP&E, goodwill. So total assets, $344 billion. And then you have all your liabilities and your equity. So liabilities plus equity equals $344 billion. Here are some ratios that are tied to the balance sheet. Some ratios are entirely on the balance sheet. Current assets, you could find that on the balance sheet, and current liabilities, you can also find that in the balance sheet. Net income is on the income statement, equity is on the balance sheet. So if you wanted the 2021 current ratio, you would just look on the balance sheet, take the current assets for 2021 and the current liabilities for 2021. But anytime a ratio is mixed, meaning one number is from the income statement, another number is from the balance sheet, that means you have to take the income statement from 2021 and the average numbers on the balance sheet. You can't just take the 2021 equity number. You have to take the equity for 2020 plus 2021 and the average. So you have to take those 2 numbers, add them together, and divide by 2. And you could look at the quick ratio or cash ratio to make sure the company is liquid enough to get through the next 12 months. Because the quick ratio strips out inventory and the cash ratio only has cash in the numerator. And if you want to find out how long it takes the company to turn inventory into cash, you can use the cash conversion cycle. It's days inventory outstanding plus days sales outstanding minus days payable outstanding. Days inventory outstanding is average inventory over COGS, and here's the next 2. So to summarize, the balance sheet is just a snapshot of the company's assets, liabilities, and equity. And it's used for many different types of purposes. If Warren Buffett was looking to acquire a company, he would ask to see their balance sheet. It's also used by management. If they notice some assets aren't being used, they may liquidate them. And if people are looking to invest in the company, they may use the balance sheet to identify if the company can expand or pay down its debt. And if a bank is looking to lend to the company, they may look at their balance sheet to make sure they're creditworthy if they should lend to that company. Please let me know if there's any other types of videos you want me to do in this format. It would really help me out if you left a like and subscribe to the channel. Thanks for watching.